My name is Brett Sininsky, and today we're going to talk about using your IRA and 401k to invest in real estate and other alternative assets. I've been a consultant here for a while now, and my specialty is helping people through our consultation process understand the products we offer, the self-directed IRA and the solo 401k, and whether it would be a good fit for that prospective client or not, and talking through that whole scenario. So at the end of this, I will make an offer that you may book a call with me at your convenience. It's a free consultation, one-on-one, private, to just discuss your situation and see if see where the conversation goes. Whether you become a client or not, that's okay. Either way, you are going to walk away, I promise you, not only from this webinar, but from any one-on-one consultation that we do with a lot more information than you had to begin with. So first of all, we're not a fiduciary. We don't provide legal advice or investment advice or accounting or other professional advice. This is educational. If you do need advice in those areas, we recommend that you seek out those competent professionals. So Sense Financial has actually been around since 2010, and we are a boutique financial firm specializing in the self-directed IRA and solo 401k. Prior to coming on board with Sense Financial, I have had my real estate license for a little over 10 years now. And I still have it. I'm still active in it, though my main focus is Sense Financial. So if anybody wants to talk real estate, I'm happy to. Many of our clients are real estate agents and, of course, real estate investors. And so I do have that background in addition to my specialty here at Sense Financial. So our mission here is to help clients obtain control of and protect their retirement accounts. Proverbs 21:5 says, "Good planning and hard work lead to prosperity." Absolutely true. You work hard for your money, and we want to come alongside you and work hard for you as well in helping you plan for your future, and at some point have the option of retiring with dignity, which is our goal here. And we'd love for you to have that option sooner rather than later. Why should you listen to me? Well, as I mentioned already, we've been around since 2010. We have over 3,000 clients that we've established well over 4,000 accounts for. And we also have 5-star reviews on all the major review platforms, Yelp, Google, Facebook, BiggerPockets, Trustpilot. Feel free to check those out. Our clients do like us. Most of our business comes from, I'd actually even say most of them actually love us because we offer unlimited client support, and most of our business comes from referrals, and most of our referrals come from our existing clients, for sure, without a doubt. And so what we're going to focus on today is conventional versus self-directed, and how to use the self-directed accounts to invest in alternative assets such as real estate, as I mentioned. The quick diagram here on the left side, you have the bus, which is the track that the bus has to stay on the track. You have to get there at a certain time to the bus stop. You get dropped off at a certain place. You have to walk to and from the stop, from your original destination and from the stop to your next destination. And you're restricted and confined to where that bus goes and the pickup times and schedule that is predetermined. That is the conventional side. That represents the conventional side of investing. And what we all know about as far as the conventional side, that's Wall Street, right? That's stocks, bonds, mutual funds, ETFs. That's your Vanguards, your Fidelity, T. Rowe Price, Edward Jones, your 401k at work, all this sort of thing. Nothing wrong with that at all. We'll talk through I think the benefits a little bit of that, but our main focus is going to be on the self-directed side of things into alternative assets. And so that's why you see this off-road vehicle here. It's 4-wheel drive, can go through water, it can go on the highways, the byways, it can go over curbs, over rocks. It has a higher clearance, and you're not restricted to the roads. But the benefit of it is that not only can it go off the road, but can also stay on the road. And we'll talk more about what that looks like here in a little bit. With the self-directed retirement account, that allows for alternative asset investing, because let me be clear, you will hear the term self-directed from some of the major custodians that I mentioned, Vanguard, Fidelity, etc. Uh, okay, maybe they're self-directed, but they're self-directed uh, with the restriction of what those custodians offer: stocks, bonds, mutual funds, ETFs. With alternative asset investing, whether it's your IRA or 401k, you have virtually unlimited investment options. You can become a private lender. You can invest, your 401k IRA can invest in crypto, in precious metals, tax deeds, can own commercial real estate, residential real estate. It can invest in syndication, multifamily opportunities, public storage, private businesses. The list goes on. We'll talk about what the IRS says you can't invest in a moment. And that's all they say. They don't have a list of what you can invest in because there's no way to exhaust that list. So outside of disqualified parties and prohibited transactions and a couple areas you can't invest in, the sky really truly is the limit. In fact, I just ran across one of our recent clients. We set up a solo 401k for him, and he's actually running a hard money loan business. That is his sponsoring business of his 401k. He's going to take that expertise he has from running that business and not only make contributions to the 401k from that business, but he's going to use the money in the 401k to invest into more hard money loans. And so he's going to use that expertise there. He's getting 14% plus a couple points up front on these 6-month terms, generally a balloon on the end of it, but the points are paid up front. And so 14% is great. I mean, you can get that maybe semi-frequently or infrequently in the stock market, but not consistently. And I'm going to talk more about what that means to contractually have an agreed upon return that is contractually guaranteed. And we'll talk more about what I mean by that. First off, an example: Brad and Jennifer, real estate agents locally, actually. And Brad and Jennifer, they had some investment money from former employers, some IRAs, and when they started their business in real estate, helping people buy and sell residential real estate, the place they call home primarily was their business, though they worked with investors too. They rolled this money they had from these accounts into a solo 401k. And not only did they do it in the solo 401k, but they focused primarily in the Roth. So his goal was diversification. Up until this point, many years ago, when he became a client of ours, he actually was primarily invested in the stock market. Had experience in real estate, of course, but wanted to diversify his retirement portfolio into real estate. And so the result is several years later, they have millions of dollars of real estate in their Roth solo 401k, which of course is beautiful because there's no taxes on the way out in the Roth. And so they invested in rentals and multifamily. And again, when I say contractually guaranteed to get a certain return, what I mean by that is, in the case of rental properties, you have an agreement between the tenant and the landlord, which in this case would be the solo 401k, for a certain amount of rent money to be paid each month. So that's what I mean by contractually guaranteed to get a return. Does it happen every month? Of course not. You have people that don't pay sometimes. You have evictions you have to go through, but that is not the norm. That is the exception for sure. So let's talk a little bit about the difference between the self-directed IRA and the solo 401k. And appreciate so many of you being on here today. This is awesome. By the way, quick note, please feel free, some of you have already done it, but feel free to type in questions along the way. I will absolutely give time at the end for Q&A. And usually we can get through all the questions that are answered. If there's any that require a little more one-on-one assistance, we will reach out directly to schedule that call and just do a better job for you. So the self-directed IRA is really designed for just about anybody, right? The solo 401k has a self-employment requirement attached to it, but the self-directed IRA, anybody can do. Now, the contribution limits for an IRA are $7,000, which is not a lot, right? So if you start a self-directed IRA from scratch, it's going to take a few years, 4, 5, 6, 8 years, whatever, at $7,000, depending on the returns you're getting, to get up to a point where it makes sense to self-direct into alternative assets. Although for 5 to 10,000, you can invest in some of these fractional opportunities in real estate mortgage funds and such. And some of these don't even have a requirement to be drawing a blank on the name of the term, to be I'll think of it, a certain type of investor with certain income and et cetera. But anyway, the self-directed IRA is for anybody that wants to do it. So because of the low contribution limits, accredited investor is what I was thinking of. The self-directed IRA, when people are establishing that, most of the time, probably 99% of the time, they are rolling over existing retirement funds, whether it be a current IRA, traditional or Roth, sometimes both. We'll talk more about that, or even a former employer 401k and such, because those contribution limits are so low. Now, on the other side, with the solo 401k, you need to be self-employed. It's primarily for the business owner and their spouse. You actually cannot have any full-time W-2 employees outside of yourself and a spouse. You can have partnerships, but not, and independent contractors, but not W-2s. And hence the word solo, right? It's for that solopreneur and their spouse. And you do have to have legitimate business activity to qualify for this. So this is actively earned income, right? You cannot live off of passive income and call that legitimately self-employed as far as qualifying for a solo 401k. So first off, we're going to talk about the checkbook IRA. So what is a checkbook IRA? Well, there are two types of IRAs. There's what I call a full custodial IRA, and then there's a checkbook IRA. Now, don't misunderstand me. Every IRA, individual retirement account, is what IRA stands for, is required to have a custodian. Now, if you have a full custodial IRA, you are going through the custodian for everything, for all investments, all transactions. So this means if you own a rental property, as an example, every single time you need to pay a bill, every single time you have a deposit come in, etc., all of this goes through the custodian. So it can cause some red tape to get through. You have to usually log into their portal and request a transaction. The custodian, for benefit of your retirement account, will sign for everything. They will be on title for everything. Again, FBO, John Smith IRA, and it can cause extra fees in the form of transaction fees, and then, like I said, time delays. Now, on the other side, with the checkbook IRA, which is the only type of self-directed IRA that we do at Sense Financial, we actually bypass the custodian using a special purpose LLC. So how does it work? Well, first off, we open a new account once you become a client with an IRS approved custodian. This is not just any custodian. This is not Fidelity or Vanguard or Edward Jones or any of those. This is a custodian that allows for alternative asset investing. And so from there, a qualified transfer, right, from one qualified retirement account to another qualified retirement account. This is not a taxable event. There's no penalties. You can transfer money from an IRA, a 401k, a 403b, any other qualified retirement account into the self-directed retirement account. Now, if it's or the self-directed IRA, if it's a current employer 401k with some exception, but not much, you cannot roll that money out until they're a former employer. If you're over 50, there's a chance you could roll out some of the contributions that you've made to another qualified plan. But typically, if you're not and you're still employed there, it's kind of stuck in that employer 401k plan until you leave that employer. So that qualified transfer is set up. From there, a special purpose LLC is created. It's single member. That single member is not you. That single member is the IRA. You are the manager of this LLC, which is what gives you that checkbook control. And this is how we bypass the custodian. So all assets, all investments, all accounts, um, title to real estate to everything is in the name of the LLC, which is, again, the only member is the IRA. And so the bank account from there is funded. So the transfer set up, goes to the custodian, and then from the custodian into the bank account once the LLC and the bank account is ready to go. And you literally have a checking account. Now, this applies to both the solo 401k and the checkbook IRA. You have a bank account and you can write checks, you can do online bill pay, wire transfers, and that's how long it takes you to make an investment. Many of our clients will go to investment meetings, and oftentimes at these meetings, somebody's pitching a deal. Maybe it's a wholesale deal, and you see it as the numbers make sense, right? Well, if you have to go back to your computer later and go through the custodian, if you even have a self-directed IRA set up, go through the custodian for them to issue the payment to invest in this. By the time that happens, it can be a day or two, sometimes even longer, and that deal may already be off the table, may be gone. Because if it was a good enough deal, it's not going to last, right? Well, if you have checkbook control, you actually can just write a check right there on the spot. Potentially, you could log into your app for the bank account on the phone and initiate or start some kind of wire transfer from your bank account to this investor to buy this property or invest in their deal or whatever the offering might be. And so that's just an example of the advantage of the checkbook IRA. Well, a few examples. And so all the money, the income from the investments, the returns, all the payments related to assets owned by the IRA, and then, of course, any initial investments must go into and out of the checking account for the IRA LLC. So that's the self-directed IRA. What is a solo 401k? Well, I mentioned this already. It's designed for the business owner and their spouse. So the business owner and their spouse, as long as, again, they don't have any full-time W-2 employees outside of themselves, their business can sponsor a solo 401k. So how does it work? Well, it works like this. First off, as I mentioned a few times already, you must have that legitimate self-employment activity. Doesn't matter what kind of business it is, as long as it's legal federally. Think selling, like a marijuana farm, right? That's not legal federally, even though it might be legal in California. So that type of business could not sponsor a 401k. Silly example, I know, but it's real. So that plan sponsor can be set up however you'd like, right? It can be a sole proprietor, it can be a corporation, LLC, partnership. It really doesn't matter as far as qualifying for the solo 401k. So as long as, again, you don't have any W-2 employees, the threshold is working more than 500 or more hours per year, and you have this legitimate self-employment activity, which could be driving for Uber one day a month. It could be as a real estate agent, you could sell one house every other year and qualify for a solo 401k. Many of our clients, actually, I mentioned earlier, live off of their passive income, right? They have a rental portfolio, which is amazing, and they make enough rent off of those properties to live off of. Well, that's Schedule E passive income. That doesn't qualify you for a solo 401k. But what would, and what many of our clients do, if you are managing those properties yourself, it's very simple to, as a sole proprietor, establish a property management business, open a bank account in the name, for that sole proprietorship for the property management company, pay yourself a rental fee of 10% of the gross monthly rents. And then now you have legitimate self-employment activity that can then sponsor a solo 401k. Now, I'll talk more about the contributions and how they work. In that situation, you wouldn't be able to max out the contributions because you're not making very much in the self-employment. But what it would allow you to do is roll over any existing qualified retirement accounts to the solo 401k and then self-direct those. So once you have the plan sponsor, that sponsor adopts a plan, the trust is created, and the adoption agreement, you are the trustee. This is what gives you that checkbook control. You're the trustee of the solo 401k. And so as such, you are able to make investment decisions without without being having to go through a custodian. There is no custodian. So unlike the IRA where we bypass the custodian, with the solo 401k, we actually eliminate the custodian. So it's a pretty cool thing. So the trust, the solo 401k trust, holds all the assets of the plan, and so that's how that works. So the bank accounts are in the name of the solo 401k trust. All of the investments are in the name of the solo 401k, and all the contracts are in the name of the solo 401k, just like the self-directed IRA, but it's the LLC instead of the 401k. Otherwise, it's the same principle. So once the bank account is opened, in the name of the solo 401k, all the income, all the expenses are going into and out of that bank account. Write a check, online bill pay, wire transfers, etc. In fact, the bank that we recommend for solo 401k offers up to 25 free wire transfers domestically every single month. And I don't know about you, but those can add up to 30, 40, sometimes even $50, depending on incoming or outgoing each time. So that's a big benefit to using the bank that we recommend. So how do the contributions work? And by the way, please continue. There's several questions in there right now. I appreciate that. Please continue adding those, and we will give time for that at the end. So the contributions are up over $75,000 per year per participant. So if you're over 50, you can actually contribute up to $76,500 per year per participant. So this means if there's two spouses, you get to double that, right? 76,500 times 2. Now, if you're under 50, it's 69,000. And this is because there's a catch-up contribution on the employee deferral. So how does this work? Well, you wear two hats being self-employed. You wear the employer hat and you're running the business, but you're also an employee in the business. Remember, this is actively earned business income. So you're wearing both hats. As the employee, you have what's called the elective deferral, up to $23,000 per year. Under 50, up to $30,500 if you're over 50. And this is, you can contribute for this part of it, for the elective deferral, you can contribute up to 100% of what you make or what you pay yourself. So here's a good example. If you paid yourself, let's say you have a full-time W-2 job. And for sake of ease of conversation, you're not contributing to that 401k, or they don't offer one. And I'll talk about what that would look like if you are. So you're not contributing there, but you have this self-employment on the side. Maybe you're a real estate agent and you're selling houses on the weekends. If you're an S Corp and you paid yourself on W-2 for your self-employment, you paid yourself about $25,000. You could put in 23. You have to account for some of the taxes, the FICA, et cetera. That's why 25 to get 23, but you could contribute up to 23 in that scenario. Now, where this often comes in is when you have a business owner and they're doing well, right? And then they have a spouse who they add to the business and they get paid for doing something. So myself as the business owner, if I added my wife to the business and I give her a W-2 of about 25,000, she can then take 23 out of that and put it in the 401k, which is essentially going to zero out her W-2, right? She's not going to pay any income tax on that. So that's how that works. Now, that could be either Roth contribution or traditional. And there's a difference there with the IRA, which I'll talk about after this. Now, on the employer side, this is the profit sharing. So either 20% if you're incorporated, like an S Corp in that example, or 25% of the net, I have that the other way around. 25% if you're incorporated, or 20% of the net profit of the company if you're a sole proprietor. So again, for ease of conversation, let's say you paid yourself a W-2, or your company as a sole proprietor netted at the end of the year $100,000. Okay. Not only could you put in the 23, but you could actually put in another 20 or 25,000 on top of that, right? 20% of the 100 or 25% of the 100, right? Plus the 23. So this is why the solo 401k is superior to other retirement products and vehicles, even the SEP IRA, which you can do as a self-employed. There's, some windows where the SEP makes sense. You can contribute later in the year, um, depending on when you establish it with the SEP. That's kind of a little more complication, but that I don't necessarily want to get into now. But one of the reasons the solo is better than the SEP is because the SEP IRA only has the profit sharing component. It does not have the elective deferral. So for the SEP IRA, it takes longer to get to the maximum, even though the maximum contributions are the same, because it's only the percentage of the profit or the W-2 at the end of the year. So that's how that works. Hopefully that makes sense. If you are contributing to a W-2 401k and you're self-employed on the side, you cannot double dip on the elective deferral. So if you're putting 10,000 into that W-2 and you're under 50, you would only have the capability of putting in another 13 on the elective deferral side only, but you can go all the way up to 69,000 or 76,500 with the profit sharing component that we talked about, the 20% or 25%. Proverbs 21:20 says, "The wise man saves for the future, but the foolish man spends whatever he gets." All right. We talked a little bit about the checkbook control. Both plans have it. I'm actually not going to belabor that anymore. One of the other benefits to let me talk about the Roth real quick. So with the Roth, the solo 401k has a Roth and traditional component built into it. Okay. So it's one plan, and you can have two different accounts, checking accounts, for lack of a better term. That's essentially what they are. One is designated for Roth funds and one is designated for traditional funds. It's really that simple. And so you can make contributions, again, all the way up to the 69 or the 76.5 for the year in the form of Roth or traditional or a combination of the two. So it's really a cool way to maximize the Roth contributions, whereas the Roth IRA contributions are 7,000 or 8,000 if you're over 50. So it's literally 10 times the amount that you can put in the Roth. You can do a Roth conversion anytime as well. Now for the IRA, it's either a Roth IRA or it's a traditional IRA. It's not both. So the solo 401k is combined under one umbrella, one plan. This is for husband and wife, by the way, both spouses. But with the IRA, it's either Roth or traditional. So if you want to self-direct both of those types of funds, you're having a Roth self-directed IRA and you're having a traditional self-directed IRA, and they're two different IRAs. Okay, so I wanted to mention that. Either one you could do, can be converted to Roth. There's some components depending on your situation that would be discussed if you were considering that. But it's much easier inside the solo 401k because it's already built into the plan as far as both of those types of accounts go. Okay, let's talk about using leverage. Probably one of my favorite parts of this. First of all, not only if you invest with agreements, what I mean by that is contracts, right? Whether you're private lending or lending money to a syndication, or investing in a mortgage fund, or investing in rental real estate, all using your retirement account, or not for that matter, but we're talking about inside your retirement account, you're contractually agreed upon to get a certain return on that money. Again, things happen. There's risk. Okay. Nobody here is guaranteeing a certain amount of return forever, but per the contract, you're going to get it. Now that's not the same with investing in Wall Street. As far as I know, there's no guarantee of any return contractually or otherwise. So one benefit of why using a self-directed retirement account for alternative asset investing can be so powerful. The other way is using leverage. No one will ever give you a loan that I'm aware of to go buy more S&P 500. It just doesn't happen. But you can get leverage to go buy real estate, right? With 30 to 50% down, you can double or even more the amount of real estate you can buy, which means more appreciation. It means higher rents coming in. The property is going to have to cash flow. So you're not making a bad investment if usually you're not making a bad investment if the lender is doing their due diligence on the underwriting process to make sure that it's a good deal that they should actually do the loan on. It's got to be non-recourse. You can't provide a personal guarantee. The property is the only security for the loan. Okay. Again, it's got a cash flow, not a lot, a few $100 a month. You do need to have some reserves, not personally, in the retirement account. And then for the IRA, this will trigger what's called a UDFI tax. I'm not going to get too into that because it's a little complicated for this call, but just know that in the IRA, if you have leverage on real estate, it's going to trigger this tax. And then if you have leverage on real estate within a solo 401k, it is exempt from UDFI on leveraged real estate. So another reason why the solo 401k is the superior product. We do have a list of private lenders and banks there at that URL, SenseFinancial.com / non-recourse lenders, that you can visit and see what their terms are, because they all have different terms that they offer. Feel free to call them up and talk through situations. As always, we recommend, especially in an IRA, before you invest in real estate, that's going to trigger UDFI because you're getting a loan. We recommend you, of course, run that by your tax advisor so you know what that looks like. Let's talk about the disallowed investments. Now, there's two categories. In the IRA, collectibles, that's my image there of baseball cards and stamps, but it could be paintings, it could be exotic vehicles, anything that's considered a collectible is off the table for both the 401k and the IRA. In the IRA, you can't invest in life insurance. It is possible to do that a certain way in the 401k, but most of our clients are not looking to do that. So just suffice it to say, life insurance and collectibles are off the table. The other way is disqualified persons, which can equal what are called prohibited transactions. So what that means is the lineal descents that you have, okay? You, your spouse. Now, that's not a lineal descent, but Bible says you and your spouse are one when you get married, right? So you're one person in terms of this, okay? So you, your spouse, your children, their spouses, your parents, and your grandparents are all disqualified people, which means you can't get paid by anything. So if your retirement account owns a rental, you can't manage that rental and get compensated for it. You can manage it, though we don't necessarily recommend that. It's easier and cleaner to just have a third-party management company when your retirement account is the owner. But you technically could do it, but there's some restrictions to what you can do because you can't do any actual work on behalf of the IRA or 401k. The easy way to say it is you can do white-collar work, but you can't do blue collar work. So I can hire the person that swings the hammer, but I can't swing the hammer myself. Okay. If you're managing the property, it's going to be hard to go and show it to prospective tenants without violating that. Probably it's okay. I've heard attorneys say that specialize in self-directed retirement accounts that you could open the front door and let them view it, but I think that's a gray area you're probably best just staying away from. So I would build into the pro forma property management fee, just so that even if you do manage it and you get one later, at least it's already built into the numbers and it's not going to make you go negative if you end up having to incur that expense each month. And so that's that. Now, another example is if my retirement account owns a rental property in, let's say, I don't know, New York, and my child is going to go to Syracuse University, she or he can't go stay at that rental property because they're disqualified people. So I can't personally benefit, and none of these disqualified people can personally benefit from anything that is owned or invested in by the retirement account. Okay. There's some nuance to this, but just suffice it to say it should be arm's length, third party at all opportunities. And so most of our questions, we offer unlimited client support. I've said that a couple times now. Not most of, but a lot of the questions we get throughout the life of a client is, I'm looking at it doing this type of investment. Is this okay? And we advise it's a disqualified, it's a prohibited transaction, or it's not a prohibited transaction. Your brother, your uncle, your sister, your friend, they're okay. Like if they own a business and you want to give them some seed money to start that business or invest in their business and it's not publicly traded, you can absolutely do that without violating any sort of prohibited transaction rules with the IRS. If your brother is a general contractor, you could hire him to do repair work on your rental property. That's perfectly fine. All right. So I think I belabored the disqualified persons enough. This is a chart about the IRAs versus the solo 401k. So the self-directed IRA, that's the full custodial one we were talking about. The IRA LLC, of course, is what we do here at Sense Financial. And then the solo 401k is there on the right. So I think we covered all of this. One of my, I think one of my absolute favorite aspects of the solo 401k is, aside from the contribution limits, which of course are much higher, is the built-in Roth component, which is huge. No UBIT on leveraged real estate is another major benefit. And then it does have the participant loan option. We didn't talk about this. I'll tell a story to kind of explain this. We had a client who was a nurse, and she had a W-2 job, but she was also a traveling nurse. So she was doing some independent contractor work. She was getting a 1099 at the end of the year, filing a Schedule C. And what she did is she went to her CPA and said, "Hey, I've got about $10,000 of high interest credit card debt I want to get rid of." And the CPA said, "Well," and then she had an IRA she was going to take a distribution from. The CPA said, "You better take out about 20, because between taxes and penalties, you're going to need about 10, give or take, to cover, that part of it, right?" So she was going to liquidate this money, 20K, to pay off higher interest credit card debt. Well, we established a solo 401k for her, and the solo 401k has a participant loan option of up to $50,000 or 50% of the total plan value, whichever is less. And she came over to us. She didn't have to take out the 20 to pay off 10. She didn't have to take out 15 to pay off the 10. She had to take out 10 to pay off the 10. Now, she traded one loan for another, but the new loan was paying her retirement account back. So she's benefiting from that down the road, and she's paying interest back, and much less. I don't know what her interest rate on the credit card was, but it was probably 20% or more. In the participant loan option, it's always 1%, prime plus 1%. So prime just dropped. It was 8.5 until a few weeks ago, and now it's 8. So about 9% is what you would be paying back to your retirement account instead of some credit card company, which would be like 20% or more. So that's an example of the participant loan. We have clients who are running fix and flip businesses. In a lot of cases, that's the sponsoring business of their solo 401k. And they establish a solo 401k not only to put some of that fix and flip income as contributions into the 401k, but they establish the 401k to take advantage of the participant loan option to then take that money and use it for what would otherwise be a prohibited transaction. They put that money into their flipping business, again, 50K or 50%, whichever is less, and they utilize that for the repairs or acquisition of more flip opportunities or whatever the case may be. And then they pay themselves back, and they rinse and repeat that until they build up enough capital in their fix and flip business to where they don't need to do that. So it can be a good way to kind of get some seed money, if you will, to start that business or supplement it. And there was something else I was going to say on that same topic. I'll think of it. So anyway, that is that. We do have a free ebook, IRA Makeover, that Dmitry Fomachenko, the founder of Sense Financial, wrote, and it's not just about IRAs. It talks about the solo 401k as well. So if you haven't seen this and you're looking to learn more, first of all, we're happy to jump on a call with you, and I'll tell you how in a second. But you can also go to that URL, SenseFinancial.com /IRA Makeover, and you can download that ebook. So if you want to jump on a call, you can visit SenseFinancial.com /free consultation, and we're happy to talk to you. And again, no pressure, no obligation. There's no hard selling at all. If we get on a call, we're going to provide value to you in the form of what your specific situation looks like and what we recommend. And if it's a good fit to do business with us, great. If not, that's okay too. Like I said, you're going to leave that call with some stuff that you didn't know before, I promise you. And now I will start going through some of the questions. So let me open that part of it up. Let's see here. All right. So let's see. AJ is asking, does this self-directed account provide investment in crowdfunding real estate deals and tier 3 option trading? Well, AJ, thank you for the question. Neither one of those are prohibited, of course. Yes, you can crowdfund real estate deals. That's not a problem. We do not at Sense Financial offer retirement accounts. Excuse me. We don't offer investments directly. We're happy to make introductions to people we know and have done business with, and in some cases ourselves, or we just are told about these companies from our investors that they're good. And so we can make some introductions, but you're going to have to do your own due diligence. We're not going to tell you to invest with somebody or not invest with somebody. But if you came to me and said, I'd like to invest in syndication opportunities in multifamily, then I have several people, more actually, that I could introduce you to that specialize as operators for syndication. So that's not a problem to make those introductions. Tier 3 option trading, that's a little out of my purview. It's not prohibited, but if you are running an active business in your 401k or IRA, it is going to be subject to that UBIT tax, the unrelated business income tax. So the solo 401k is only exempt from that tax on leveraged real estate. But if you're running an active business, in fact, I just had a consultation with a guy yesterday who he wanted to buy a store, start some kind of store. I don't know what he was going to sell, but it was going to be a brick and mortar operation. And he wanted to do this in his IRA. And I said, okay, well, yeah, you can do that. It's not a prohibited transaction. What is prohibited is you working. Remember, I said white collar, blue collar. You can't work in the business. You have to literally hire everything out. And so that's fine. He understood that. But what he didn't know about was the UBIT implication on all the income generated, because that's an active business. So remember, retirement accounts are designed to be invested passively, not actively. And so the IRS is going to level the playing field between a private individual running a business, no matter what the setup is, sole proprietor, corporation, it doesn't matter, and you running it in your retirement account. It wouldn't be fair for you to run this active business in your retirement account and have it be tax advantaged and pay no taxes either ever if it's Roth or down the road until when you take distributions, where this other individual has to pay the regular income tax on that or corporate income tax. So the UBIT scales up to 37% once you get to around $12,000 for the year. Now you can deduct expenses, you can depreciate and that sort of thing. Certainly something to cover with your CPA, not our area of expertise, but you can do all that before you calculate what is actually subject to the tax. But if you run an active business like trading, like day trading, I'm not aware of a way to do that passively unless you provided like money, like a loan to somebody who was doing that and they're giving you a return. But if you're going to participate as a certain percentage of the profits from that, you're more in like the business owner partner category on that. Again, something to cover with your CPA. So sorry for the long-winded answer, everybody, but AJ, I don't necessarily recommend the trading in there. And if you do want to do that, definitely cover that with a tax advisor before you do. Shakar, thank you for the question, is asking, is the self-directed IRA protected from lawsuit? Well, it is. You do have all the assets in an LLC. So the LLC has, limited liability protection. Absolutely. But these are retirement accounts, right? So the IRS already provides, and the government already provides a certain level of protection from them. Now, don't misunderstand me. If your 401k or IRA owns a rental property, there's liability involved with that, of course. But you're going to have hazard insurance, just like any other rental real estate you would have, inside, outside your retirement, it doesn't matter. So you'll open a policy in the 401k, not you personally. And on top of that, we always recommend you get an umbrella policy. I mean, you can get $1 million umbrella policy for like $400 or $500 a year. It's not expensive. And so that usually provides sufficient enough liability protection. And I would suggest doing that in the LLC, or even in the case of the solo 401k, which is a trust structure and not an LLC structure. So that's usually sufficient, but we're not asset protection attorneys, so seek out proper guidance on that. Sorry, the names are super small here. Namrata, hope I'm saying that right. Does real estate and solo 401k always have to be passive to avoid UBIT and UDFI? If I buy a furnished rental that is managed by property management in the solo 401k trust, will I still have to pay UBIT or UDFI taxes? Well, no, it depends. I mean, that's passive. Your question is passive income, right? I don't understand that. But if you're running, even if you're doing like short-term rentals, that's usually reported as passive, whether you're doing it in a retirement account or not. Nobody wants to pay actively earned business income on those profits, so you'd be okay there. If you're flipping in the retirement account, that could be subject to the UDFI. Well, UBIT really, not UDFI, because UDFI is unrelated debt finance income, which is in the IRA, as I mentioned, for leveraged real estate, not in the 401k, which basically makes that income subject to the UBIT. But UBIT also applies, as I've already mentioned, in running an active business from that income, and also in the IRA on the leveraged real estate. So fix and flips can definitely equal running an active business. But here's the thing. It might make sense. We actually have a client who does nothing but fix and flip in his solo 401k. He pays the tax. He's okay with it. It makes sense for him. If the nature of the retirement account is to buy and hold rentals, and you're acquiring a few per year, and you have 10, 15, 20, whatever it is, rentals in the 401k, and you flip a couple, 3 per year because the numbers just make more sense to do that. The IRS is not going to say you're running an active business, because that's not the nature of the account. The nature of the account is this passive investing, and then with some really small exceptions, you're doing these flips. So you'd be okay there. But if you flip those numbers around and you're buying a few rentals per year and you're flipping 10 or 20 properties a year, yeah, you're going to pay UBIT on that. So hopefully that answers the question. With the self-directed IRA, can I invest in treasury bills? Peter, you can. You have to find a provider that's willing to allow the self-directed IRA LLC to do that, but there's no IRS restriction behind it. So yeah, something to cover with your tax advisor before you go too far into that, but it's certainly doable. I had a consultation with a guy who was trying to do that. I don't know what he did. He's not a client of ours yet, and he may have gone to a different company for some reason, or for whatever reason, but that was what he wanted to do. He wanted to invest in treasury bills. But most of our clients are not looking for Wall Street or that type of bill, but there's certainly no restriction on it. Sold real estate recently. This is Edith. Can I roll the funds into the checkbook IRA? Do I get tax advantage by doing that? Well, Edith, the IRA contribution limits are $7,000 or $8,000 per year. And you have to show the income to be able to make those contributions. So yeah, you could do that, but you're restricted to those amounts. Now, if that's like, I don't know if that's a long-term rental or not, but if that's a fix and flip, and that's the sponsoring business of the 401k, all of that could go into the solo 401k, right? Up to that $69,000 threshold. So hopefully that answers that question. Appreciate all the questions, guys. Richard is asking, can an IRA be rolled over into a solo 401k? If so, can only IRA be rolled over and not Roth? Yes, that is correct. I did not mention that. Thank you for the question. The Roth IRA is the only type of retirement account that cannot go into a 401k. Um, so yeah, that's right. But the Roth IRA can become a self-directed Roth IRA, and the Roth 401k can go into a solo 401k as Roth funds. Knaz, I think I offered that question about Airbnb. You could do short-term rentals. No, those people cannot stay there. Direct family members. So the follow-up question from Knaz is, can we go through the Airbnb site to book the rental for family members? No, not the disqualified parties. Again, you, your spouse, your children, their spouses, your parents, and your grandparents. Anybody else can stay there. Is there any consideration if I move to another state? Peter, good question. No, I mean, if your situation changes, as I mentioned, we offer unlimited client support. So you're going to let us know that we need to amend either the documents or your mailing address. But other than that, no, it shouldn't change a whole lot. Yeah, there might be some exceptions. Actually, there is if you're subject to this UBIT tax we've been talking about. I'm not an expert in this area. Check with your tax advisor, but there's some states, I think it's Texas, don't quote me on that, where they have like an additional tax on the income, corporate income. So I'm not sure about that though. That's a good question. The tax advisor question for sure. Knaz also is asking, okay, let's see. Okay, I'll address that. Does your Chella's asking, does your company file the taxes for the solo 401k, or that's my responsibility to give my CPA? So, well, I'm not sure what tax you're talking about. There is no tax due. If it's distribution and it's being added to your income, or if it's a Roth conversion, it's being added to your income, you're going to get 1099 for that. We can help you create that 1099, or you could do it on your own. And yeah, you'll turn that into your CPA so that they can file the taxes appropriately. But if you're talking about UBIT tax, that's something that you would do with your CPA. We do not do any tax filings here. If you do need to file the Form 5500 EZ, which is once you get up to 250,000 plus of total plan assets in the solo 401k, then yeah, you would need to file that form, which essentially is like it's the valuation of the plan at the beginning of the year and the end of the year. So here's the value on January 1st. Here's the value on December 31st. And so you're going to be able to fill that out. It's real easy. It's 2 pages. If you need help with it, we're happy to help you with it. We can even file it. We do have a small fee if you ask us to file it, but if you're going to fill it out, you might as well file it yourself. It's really not hard to do. And there's a website you can go to do that. Can you deposit directly? Chella is also asking into the solo 401k from personal accounts or only rolling over from other retirement. Well, yes. I mean, the solo 401k contributions have to come from the sponsoring business. So it doesn't, if you have a business bank account, that's where those contributions are going to come from. If you have an S corp and you're doing payroll, those elective deferral, the 23 or the 30,500, have to be done through the payroll. Okay, so that just like a W-2 401k that you have with some other employer, those contributions are reflected on your payroll and done through payroll. And so that the payroll company would, issue some of the money to you into your business checking account as pay, into your personal account as pay, and then some of it would go into the 401k checking account as contributions. There's more flexibility on the profit sharing. You're going to calculate that at the end of the year so you know what your full W-2 looks like, so you can properly calculate 25%. Or if you're doing 20% of the net profit as a sole proprietor, you have to know what the net profit is, and you don't know that until the year is over. So you have up until filing to handle that component of it. So that could come from a checking account into your 401k checking account, that's not a problem. But generally speaking, if it's coming from the business as a contribution, you're going to want it to come from the business checking account, right? That's going to be the cleanest, especially for your bookkeeper CPA. So I highly recommend you do it that way. Any further questions on that, you should definitely check with your tax advisor. Donnie's asking, recording. Yep, that'll go out about an hour or two after this is over. And no whole life policy investing with the self-directed IRA. No, that's Peter. That is not something that you can do. Although I don't know if it's whole life or universal or some other type of insurance. Not my area of expertise, but I did just come across somebody. This is a whole other. This is not on the retirement account conversation, but I did come across somebody who sets up these policies. Again, universal whole life. I'm not sure in the name of your company. I believe you have to be incorporated, so S corp, C corp, and you can actually pay the life insurance premium as a business expense instead of paying it personally. So, not my area of expertise. If you want an introduction to that person I'm mentioning, I'm happy to do that. But that's outside the scope of this call. Just thought I would mention that. And Shakar, you are welcome. That's going to wrap up our call today. Thank you so much, everybody. Really appreciate it. Again, reach out if you want to talk one-on-one. We're happy to do so. All right. Thank you all. Take care.